What is decentralized finance? Understanding decentralized finance. Decentralized finance, also known as DeFi, uses cryptocurrency and blockchain technology to manage financial transactions. DeFi aims to democratize finance by replacing legacy, centralized institutions with peer-to-peer relationships that can provide a full spectrum of financial services, from everyday banking, loans and mortgages, to complicated contractual relationships and asset trading. DeFi runs on blockchain. Blockchain and cryptocurrency are the core technologies that enable decentralized finance. When you make a transaction in your conventional checking account, it's recorded in a private ledger, your banking transaction history, which is owned and managed by a large financial institution. Blockchain is a decentralized, distributed public ledger where financial transactions are recorded in computer code. When we say that blockchain is distributed, that means all parties using a DeFi application have an identical copy of the public ledger, which records each and every transaction in encrypted code. That secures the system by providing users with anonymity, plus verification of payments and a record of asset ownership that's nearly impossible to alter by fraudulent activity. When we say blockchain is decentralized, that means there is no middleman or gatekeeper managing the system. Transactions are verified and recorded by parties who use the same blockchain, through a process of solving complex math problems and adding new blocks of transactions to the chain. Advocates of DeFi assert that the decentralized blockchain makes financial transactions secure and more transparent than the private, opaque systems employed in centralized finance. Risks and downsides of DeFi. DeFi is an emerging phenomenon that comes with many risks. As a recent innovation, decentralized finance has not been stress-tested by long or widespread use. In addition, national authorities are taking a harder look at the systems it's putting in place, with an eye toward regulation. Some of the other risks of DeFi include: 1. No consumer protections. 1. DeFi has thrived in the absence of rules and regulations. 1. But this also means users may have little recourse should a transaction go foul. 1. In centralized finance, for instance, the Federal Deposit Insurance Corp. FDIC reimburses deposit account holders up to $250,000 per account, per institution if a bank fails. 1. Moreover, banks are required by law to hold a certain amount of their capital as reserves, to maintain stability and cash you out of your account anytime you need. 1. No similar protections exist in DeFi. 2. Hackers are a threat. 2. While a blockchain may be nearly impossible to alter, other aspects of DeFi are at large risk of being hacked, which can lead to funds theft or loss. 2. All of decentralized finance's potential use cases rely on software systems that are vulnerable to hackers. 3. Collateralization. 3. Collateral is a thing of value used to secure a loan. 3. When you get a mortgage, for instance, the loan is collateralized by the home you're buying. 3. Nearly all DeFi lending transactions require collateral equal to at least 100% of the value of the loan, if not more. 3. These requirements vastly restrict who is eligible for many types of DeFi loans. 4. Private key requirements. 4. With DeFi and cryptocurrency, you must secure the wallets used to store your cryptocurrency assets. 4. Wallets are secured with private keys, which are long, unique codes known only to the owner of the wallet. 4. If you lose a private key, you lose access to your funds. There is no way to recover a lost private key. How to get involved with DeFi. If you'd like to learn more about DeFi in a hands-on way, here are a few ways to get started. Get a crypto wallet. Start by setting up an Ethereum wallet like MetaMask, then funding it with Ethereum, says Kosman. Self-custody wallets are your ticket to the world of DeFi, but make sure to save your public and private key. Lose these, and you won't be able to get back into your wallet. Trade digital assets. I recommend trading a small amount of two assets on a decentralized exchange such as Uniswap, says Doug Schwenk, chairman of Digital Asset Research. Trying this exercise will help a crypto enthusiast understand the current landscape, but be prepared to lose everything while you're learning which assets and platforms are best and how to manage risks. Look into stablecoins. An exciting way to try out DeFi without exposing oneself to the price swings of an underlying asset is to try out TrueFi, which offers competitive returns on stablecoins, aka dollar-backed tokens, which aren't subject to price movements. Kosman says, the key to any foray into a new financial space is to start slow, stay humble and don't get ahead of yourself. Keep in mind that digital assets traded in the cryptocurrency and DeFi worlds are fast-moving and there's significant potential for loss. The future of DeFi. From taking out the middleman to turning basketball clips into digital assets with monetary value, DeFi's future looks bright. That's why people like Dan Zimmerman, head of financial relations at IOTA Foundation, a DeFi research and development group, see both the promise and potential of DeFi as far-reaching, even though it's still in the infancy of its capabilities. Investors will soon have more independence, which will allow them to deploy assets in creative ways that seem impossible today, Zimmerman says. DeFi also carries big implications for the big data sector as it matures to enable new ways to commodify data, Zimmerman says. But for all its promise, DeFi has a long road ahead, especially when it comes to uptake by the general public. The promise is there, says Zimmerman. It's up to us to continue educating people about the potential, but we also need to keep working hard to build the tools that will allow people to see it for themselves.